Good afternoon, everybody. Happy Monday to everybody. Hope you're doing well. Markets are in the green a little bit today. We're just taking profits left and right, which is a good thing. I know we weren't here Friday because of the shortened trading day, so I hope you all had just a spectacular Thanksgiving with hopefully with family and friends, and you had a great weekend. Am I coming through today? Oh, Van Gal, Zora, yes, what a market today. It is a good one. Oh, thank you. Thank you. You know, it's about 20 degrees frigid here in Chicago. We haven't gotten the snow that a lot of other places have gotten, but it is definitely flannel weather. All right, everybody, can everyone hear me okay? Here, and I know Zora can, but everybody hear and see me okay? Because we are going to talk about broken wing butterflies today. Before we do that, though, let's talk about some of the big movers today. SMCI, boy, that stock has really come back from, I don't want to say from the dead, but it has recovered its 2.5x where it was just a couple weeks ago. So big mover. Google, everybody. Everybody remember why we got in Google here? We had talked about we've been waiting for it to come back down to the 200-day moving average. It did. We got in. It is paying off. That is for sure. Same with NVIDIA. NVIDIA last week as it touched the 50. We got in. It is paying off. So we are, definitely nimble, definitely taking advantage of what is going on out there. Lots of activity, but we have to really keep things close to the vest because this time of year, especially, we're going to start seeing lighter and lighter volumes. And so maybe some more significant moves because of that. But that being said, volatility is not going away anywhere, guys. It is not. There's too much in the headlines to kind of direct this market or maybe, give this market either a further boost or a little pullback. There's just way too much going on. We've got the Fed meeting in a couple weeks, rates where they are. So again, we need to stay on top of things as we have been doing. All right, guys, I definitely want to get into our broken wing butterflies today. So without any further ado, let's take a look. First off, what's in a name, right? Because if you think about it, I think that was this morning, Robert, with Intel. If we talk about different option strategies, especially if you're new to trading, boy, you could, just get so caught up in thinking, oh my God, what is this kind of thing? What is a vertical? The easiest kind of strategy, right? Spread strategy. What is a condor or an iron condor, a butterfly, broken wing butterfly? Strangle, straddle, Christmas trees, back spreads, ratios. Man, unless you're really confident in your option trading or realize that it's just a name, it can be very intimidating. But when we break down just about any type of strategy, any of those weird names, what it comes down to is it's really just a matter of being a combination of another type of strategy. Yes, it can be overwhelming. I get it. And that's why we need to take a step back and we need to really just break down, which we're going to do today. We really need to just break down the components of these spreads. Okay? So first off, before we get into broken wing butterfly, let's discuss what a regular butterfly is. Okay, and there's a nice, beautiful monarch butterfly there, but a butterfly spread is just the combination of a bull spread and a bear spread. Okay, your risk is 100% completely identified, completely capped, as is your profit. Okay, a butterfly has equal distance between the options we're using. And I'm going to show you an example here. Okay, just like every other spread that we talk about, no matter what it is, debit, credit, whatever it is, your max profit is always going to be at the short strike. And when you use a butterfly, you have an equal amount of long and short options. So even though the ratio is 1 to 2 to 1, okay, it's an equal amount of long and short options. Let's take a look here. I have created this butterfly in NVIDIA. Okay, and then we're going to compare that to a broken wing butterfly. So as you can see on the screen here, okay, here is a call butterfly. Butterflies can be calls or puts. You can do it for an upside move, downside move, or you can do it, quite frankly, if you think a stock is just going to sit still. Okay, the goal, the key is, like we always talk about, maximum profit at the short strike. Okay, in this case, in NVIDIA here, we have the 140, 145, 150 call butterfly. And what you will notice is the ratio. Okay, the ratio is 1 by 2 by 1. Okay, so we have an equal amount of long and short options. We are long the 140 call, long the 150 call, and short 2 of the 145. So in this case, you have 2 longs and 2 shorts. Now, you can do this in any ratio, or excuse me, in any quantity you want. 8 by 16 by 8, 31 by 62 by 31. Regardless of the quantity you use, a butterfly is in a 1 to 2 to 1 ratio. And that is what makes it completely 100% risk defined. Okay. Now, to break down the butterfly name and talk about how it's just the combination of 2 spreads. This is just the combination of a bull spread and a bear spread. How is that? Well, if you think about it, we own a 140, 145 call spread. Okay? Everybody, if you own that spread, where is the best spot for that stock to go at expiration? Where do you want that stock to be at expiration if you own that call spread? Okay, that's right. You want that to be at 145 or higher. 145 or higher. Because even if it's at 150, 180, 300, doesn't matter. That is still going to be worth its maximum value of $5. Okay, now that's only half of the spread. The other half of the spread is the bear part of the spread. And that is short the 145, 150 call spread. So here is your combination of a vertical, long, bullish call spread and a vertical, short, bearish call spread. Now, if we're looking at this part of the spread, the short part of the spread, where do we want that stock to be at expiration. If we're only looking at the short side of the spread, the minus or the negative 145, 150 spread, where do we want that stock to be at expiration? We want that spread to be worthless, right? If we've sold it, we want it to be worthless. So 145 or below. Okay, because if it's 143, 140, 120, whatever it is, that part is going to be worthless. Okay, now if we combine these two spreads, because that's what the butterfly is, that's what the butterfly is. There's only one spot where this thing will max out, where the long side is going to max out, and the short side is going to max out. There's only one spot that can happen to both parts of the spread. Where is that? Where is that? And as Robert just put up there, that is at the short strike. And at the short strike, this will be worth $5. Okay, now let's run through a quick P&L on that so everybody can actually see that. This is at expiration right here. This is what, on a regular butterfly, not a broken wing, on a regular butterfly, that is what your P&L graph is going to look like. Okay, so let's go through real quickly a P&L spreadsheet so we can prove that out. So on the top part of this spreadsheet here, and everybody should be able to see this spreadsheet here. Okay, I've got our NVIDIA butterfly, long call butterfly, and here it is, the two different parts, long, the 140, 145, short, the 145, 150. And let's say we pay 80 cents to do that. Okay, let's say we pay 80 cents to do that. Well, if at expiration, okay, if the stock is below all of these call options, all of the options are going to be worthless. And at that point, we would have our max loss. Remember, we said our max loss is capped, and that is capped at the amount we pay for the spread. In this case, 80 cents. Does everybody see that? Okay, even if the stock went to zero, we cannot lose more than what we paid for this spread. Okay, now, what happens if we are at 140.80 at expiration? That would be our break even. 140.80 at expiration would be our break even. And that's because the 140 calls would be worth 80 cents. Both other ones, the 145s and 150s, are worthless. We paid 80 cents. It's worth 80 cents. There we go. Okay. Now, above 140.80 at expiration, we're going to start making some money. Okay. All the way up to the short strike. Our short strike of 145. Okay. Now, what happens, guys? What happens if we start to go over 145? Why is that not good for this position? Well, remember, we just broke it down. We have a long 140, 145 call spread that maxes out at 145 or higher. But then we have that short part of the spread, the 145, 150, that is worthless below 145, but all of a sudden at 145, that starts to be worth something. So if we go above 145 at expiration, we're going to start giving back some profits, because all of a sudden that short part of the spread is now worth something. Okay, so what happens is we will make money up to a certain point. If we get to that 150, if we get to that top strike or above, okay, if we get there and both the long part of the spread and the short part of the spread have maxed out, what can happen? Hello, Herbert. What can happen here? Well, we're still maxed out at the amount we can lose, but we would have a losing position. We would have a losing position of just the debit that we paid. Does everybody see this? Does everybody see this? So if we compare this kind of P&L graph right here, okay, loss, 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 break even, make money, make money, make money, top out right here, make less money, less money, less money, loss. Okay, there's that curve. Now remember, that is the same as what I put on here. That is the same curve. Does everybody see this? Does everybody see this? So a butterfly gives you the opportunity, okay, for a nice move, upwards, downwards, or even if it just stays in a range. Your profit is maxed out. Your loss is maxed out. Okay, everybody see that? Now, let's compare that to, man, how can we ever understand what a broken wing butterfly would be? What the heck is a broken wing butterfly? Well, there's our butterfly here with our broken wing. Okay, now the only difference between a butterfly and a broken wing is that the distance between the strikes is different. Remember, in a butterfly, the long side of the spread, the short side of the spread, equal distance, whether it's $2 wide, $5 wide, $20 wide, doesn't matter. In a broken wing, you have different distances between the long and the short side of the spread. You still find your max profit at short strike. You still have an equal amount of long and short options. Okay? But this allows for a greater delta move. So if you're more bullish or more bearish, okay, that is when this is used. All right, guys, before we go into the ins and outs, there we go. You probably could have assumed what Groucho says today. Let's get in there for the wheel, everybody. Give you a minute to get in there for the wheel. Okay, Groucho says butterfly. Okay, let's see him. There we go. Thank you, Robert. There we go. Now I see him coming through in the chat. Bingo. Bingo, bingo, bingo. Okay, Groucho, bye-bye. back to our broken wing here, guys. Okay, back to our broken wing. Again, still have a bull spread, still have a bear spread, still have an equal amount of long and short options, still in that 1 to 2 to 1 ratio. Okay, it could be 4 by 8 by 4, 12 by 24 by 12, doesn't matter. Still 1 by 2 by 1. Let's take a look now at the difference between a regular butterfly and a broken wing. And the difference in the graph, guys, we're not going to see that kind of normalized standard distribution graph. What you're going to see now is this. Okay, and you see this kind of graph because now you have a loss here. You're going to have a max gain, which we're going to show you here at your short strike. But then, unlike in the butterfly, if you go too far in one direction, here, because your spreads are skewed, and because in this case, we have, and I'll show you in a minute, a +8 and a -2, your profits remain up here. When I said +8, -2, here is this spread. So in this broken wing that is asymmetrical, we have a positive $8 wide spread. We've got the 140, 148 long spread, and then only short a $2 wide spread. Okay, so using the same principle of always want stock to be at a short strike at expiration, okay, there's only one spot here where the long spread maxes out and the short spread's worthless. And that is right there at 148. Does everybody see that? Same principle. Always want to be at the short strike. Always want to be at the short strike. But this case, we have an $8 long and a $2 short. Okay, let's see how that plays out and compares on the risk P&L chart. Okay, so up here, and I put them on the same chart, okay, so we could compare and see them together. Up here, we paid 80 cents for the regular butterfly. Here is the broken wing. So we can see, as I just had on the screen, we are long an $8 wide spread, short a $2 wide spread. Okay, now, because of that, because you have more delta, because you have more potential upside, that's going to cost more money. Okay, and in this case, the spread was $2.35. Now, let's compare. Let's compare. So, once again, just like in the butterfly spread, if the stock at expiration is below all of the strikes, okay, every option is going to be worthless, and that's going to be our max loss. Remember, our max loss is what we pay. In this case, it's more money, $2.35. Okay, now we will start making some money here, or I should say losing less once we get up to that break even. And that break even in this scenario will be at $2.35. Okay, why is it there? Well, that's what we paid. And if our long 140 strike call, if it's worth $2.35 and we paid $2.35, that's our break even. Okay, now anything over that, anything over that, okay, we will make money no matter what. Okay, we will make money no matter what. At 144, 145, 146, 147, 148. That is going to be our maximum profit. Okay, let's detail this here. And we will get to our max right there. And our max profit on that is $5.65 because the spread is worth 8 less what we paid gets us there. Now, if we start to go over 148, we're still going to make money, but we're going to start giving some back because now all of a sudden the short part of the spread, which starts with the 148 strike, is going to be worth something. Okay, and at 150, we have that. But now here's the difference. Here is the difference on the upper end of the P&L, where once we got above 150 in the regular butterfly, we got to a loss. Here, that profit is going to remain constant. Going to remain constant. Does everybody see this? Any questions at all? Bottom line is that regardless of the name of a strategy, guys, again, butterfly, condor, Christmas tree, strangle, straddle, whatever it is, okay, don't be intimidated. Don't be intimidated. It is really just the combination of something you already know. It is the combination of something you already know. Okay, does everybody see the difference here? Does everybody see the difference? Okay, that's the graph on the butterfly. That's the graph on the broken wing butterfly. And there's Groucho on our butterfly. All right, the wheel is closed, guys. The wheel is closed. Okay, and anybody that would like a copy of that spreadsheet, okay, shoot me an email and I will give you the link to that spreadsheet. All right, everyone. Here it is. Robert, where are you on here? Man, we got to always watch out for Robert, guys. Where is he on here before we go to spin? I'm looking. Why don't I see you, Robert? It's a conspiracy. Did you not put your name? Did you not enter in today? Terrace, all of these, and let me go back here for a second. All of these prices are at expiration. Because remember, what happens to option prices before expiration? They still have extrinsic value. They still have premium. Okay? So these prices are at expiration. Robert Edward F., you're good to go. It's Robert DB. Hang on, he probably did do the first one. I'm going to go back here and look really quick. I bet he did. He most certainly did do the first one. So I am going to add him back in right now. I do see the other Robert in there. You know, what's fair is fair, guys. Robert, you are now in as Robert DB. Okay, you are in as Robert DB. All right. Are we ready? Now you are in. And away we go, guys. Away we go. Today, it is Rod or Jeremy. Rod or Jeremy. It is Rod Davis. Rod Davis, are you here? Got to be here to win. Got to be in it to win it. Are you here, Rod Davis? Uh-oh, Rod. If you are not here, we're going to have to go back to the wheel. That means giving Robert another chance today. Rod, I'm going to give you 10 more seconds. Speak up or forever hold your peace. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Rod, you're out. You are out. Back to the wheel. That's a shame, Rod. Okay, here we go, guys. Can't believe you're giving Robert another chance to win. Here we go. No way is it going to be Rod again. Oh, my God. Jeremy. Jeremy, are you here? Jeremy V., are you in the house? Jeremy V., are you here? Herbert, I don't think you're Jeremy V., are you? No, I see your name on there also. Come on, another one that's not here? All right, Jeremy. Giving you 10 seconds before we spin again. Oh, Rod. Rod, finally. Finally. What do you think, guys? Do we give it to Rod? It's a good thing he just showed up. Well, since Jeremy is not here, Rod, we'll give it to you. We will give it to you. All right, Rod. Send me your email, your info. Send me your info. Okay? prosperswag@prospertrading.com. Let me know your mailing address, size of your swag, and then anybody else, okay? Anybody else that wants a copy of this spreadsheet, which you can keep. It's an Excel spreadsheet. You can, use it for other spreads, manipulate it yourself, whatever you want to do. Anybody that wants a copy of this. Oh, yes, I did misspell that. Man. Thank you, thank you, thank you. Bobby, you are the man. Prosper Swag. Rod, do you have that new email address? Prosper Swag, not Prusper or whatever that was. There we go. Anybody that wants a copy of this spreadsheet, guys, let me let me know. Shoot me an email there, and you will get a copy of this. NVIDIA Market Minds 12/2/24 PNL spreadsheet comparison. Seriously, we need more thumbs up, guys. Doesn't take a lot on your end. All right, everybody. Thank you very much. Thank you, thank you, thank you, thank you. And we will see you tomorrow, everybody. Have a great day.